This is the March 2024 Argent Wealth Management Market View. At Argent, our differentiation is our deep knowledge and practice of tax, estate planning, and investments under one roof, simplifying your life. You can connect with us on various social media sites. So the conclusion, the January-February market view noted that the bull market is likely to continue, but inflation may stay stickier than investors expect. And expectations for the Federal Reserve to cut rates in March look optimistic. Well, the bull market is still likely to continue. And the reason inflation has stayed stickier than expected is due to economic strength. And without a recession, it's unlikely the bull market gets derailed. And investors have now recalibrated their rate cut expectations appropriately, setting up potentially the next phase of the bull market. And inflation does remain on a downward trajectory, even though it's been a little bit stickier than investors expected, again, due to economic strength. Core CPI was predicted to be 3.7, but came in at 3.87, but you can see it is clearly moving downward, albeit a bit slower than economists predicted. And I think if you break down CPI, it shows economic strength within the context of dissipating inflation. Discretionary purchase like food away from home increased significantly more, 5.1%, than food at home, which increased only 1.2%. Transportation services, which oftentimes is discretionary, increased significantly at 9.5% year over year. And shelter, which includes homes, so has positive wealth effects for those who own homes, were up most in the last year and drove the increase. But if you look at most line items, they were flat or negative in the last year. So really you have homes and food away from home and travel driving the increase. So since mid-January, investor expectations that the Fed will cut rates have decreased. You can see here, expectations were that the Fed would be decreasing rates, and now there's a high expectation, current expectation, the blue, is that they will be keeping rates the same in May. Now let's look at some economic charts. So despite higher interest rates, the availability of credit to consumers and businesses is favorable. You can see here credit conditions index, you can see business credit conditions, and you can see consumer credit conditions. And you can see here the gray areas are the recessionary periods, and typically what you would see is credit conditions trending downward as a recession became more likely, and we're just not seeing that. And consumers also remain healthy. Obligations ratio, which includes debt, leases, rent, insurance, pretty much everything you could think of that you have an obligation for, is below the historical average, and that too would tend to trend in a worse way, would trend up in this instance if a recession was likely to occur. You can see it trending up towards 2008 here. It's just not happening. And businesses are in very good shape as well. If you look at debt relative to cash flow, which is decreasing, and you look at interest coverage, which is at a much higher than it's been historically, at 13 times, where the average is only about 4.5, 5 times. And employers are still in the market for new hires. There remain 1.4 times the amount of job openings per unemployed in the US, and that's a good sign, even though wages are coming down as well, as you can see in the dotted line. There's still demand for employment. And over the last 6 months, if you look at the stock market, how it's reacted to this economic data, defensive sectors have underperformed. Defensive sectors such as consumer staples, things consumers have to buy, and utilities, right? Utilities are regulated. You are going to keep your house warm in the winter. You're going to pay your water bill. These things would likely outperform if investors were starting to factor in an economic slowdown. Investors tend to migrate towards these more defensive sectors, and that's just not the case. You can see the S&P 500 is up about 15% in the last 6 months. Utilities are actually negative, and staples are only up about 3%. Earnings growth, companies. Well, this is a great chart from Ned Davis because it shows you the percent of stocks around the world that are traded and the sectors that they're in, and what sectors have higher forward earnings growth than trailing earnings growth, and that's at 82%. That's pretty high. So companies are expected to grow faster in the next year than in the past year. And when this is above 50%, it's well above 50 now, it's at 81.8, the ACWI has gained about 10.46% per annum since 2004, which makes total sense. Company is growing faster in the next year than it has grown in the past year. We also like to look at the presidential cycle. We're in an election year here. And the first half of presidential election years tend to be choppier than the second half. We've seen some choppiness to start the year. It's not too surprising. But on average, they tend to be strong years. That bodes well. So you have a lot of alignment here between the economic data, the technical data and how the stock market's reacting, and the presidential cycle. And a question we get a lot is about, well, we have, a president that maybe not a lot of people feel good about. At the bottom, you have the Gallup poll about a presidential approval rating. Right now, it's in that pessimistic zone, not the extreme pessimistic zone, but people aren't feeling good about the president in general, or the presidential candidates, I think, in general. But most do not expect that to not necessarily be a bad thing for the markets. So if you look at the data historically, unless the mood is really bad, which tends to coincide with external economic shocks like the 2008 global financial crisis, you can see here, when the mood about the president's really negative, president's in charge, a lot of people will put the blame about a poor economic situation on the president, that the market does just fine. In fact, in that pessimistic zone, the market is up about 10.3% on average, going all the way back into the 50s. So if we are, in fact, remain in a bull market, which is what I'm proposing, the mean for all bull markets is about an 86% gain over 576 market days. Well, right now we're up about 40% over about 350 days. So we're into this bull market. We're not in the early innings anymore. It started in October 2022. But if we remain in a bull market within a long-term bull market, which looks like the case, and the long-term or secular bull market started in 2009 and continues, typically bull markets within those long-term bull markets return about 105% over 751 days. So we'll see how long this one lasts if we remain in one here, but either way, there's still some runway for this bull market. Thanks for listening. You can check us out on our website, our various investment strategies. We also added some bond strategies as well. Bonds look much more attractive now than they have really in many years. So we have access to those for our clients. I'm, again, Matt Rastucci here, MBA, CFA, Chief Investment Officer, and Principal at Argent Wealth Management. Any questions, never hesitate to contact us. Thank you very much.